Hello, guys. Welcome to this class. We shall going to talk about financial statement analysis for financial management, financial reporting, and financial accounting. So I will combine the three. So the first part will be for notes, which is same for the units mentioned. Then I will divide the lessons when I'll be solving some questions. So some lesson I will do a question in financial management, another one in financial accounting, and another one in financial reporting. So welcome to this class for financial statement analysis. So when we talk about financial statement analysis, as you can see from the board, financial statement analysis is the process of analyzing the company financial statement for the purpose of decision making or for the decision making processes stroke purpose. So when a financial analyst analyzes the statement in terms of using the financial statement tools, for example, the ratio analysis, the comparative analysis, or the common size statement, then that process is what we call the financial statement analysis, and it is there to determine the overall financial health of the company and also to determine the performance of the company so that the stakeholders or the wider group of the company can use that information to make relevant decision. When you talk about the wider group or the stakeholders, these are the people who engage in the company operation indirectly, but they have a significant impact within the organization. A good example are the financial institutions. They need this financial statement. They analyze financial statement to make performance in terms of giving loans. We have what we call the creditors, suppliers. We have the debtors. We have customers. So all those people rely to this financial statement analysis in order to make the wider or the informed decision when it comes to the financial statement. So we have the three tools for financial analysis. We have the ratio analysis, we have the comparative analysis, and then we have the common size statement or the common size analysis. Now, I think we can start with the first one. We can start with the common size analysis. Common size analysis, and we have two type of them. Common size analysis. Common size analysis. When we talk about common size analysis, it is divided into two categories. So we have the vertical analysis and we have the horizontal analysis. For vertical analysis, when it comes to the financial, to the income statement, all items are based on the or are based on total revenue. While when it comes to the statement of the financial position for the vertical statement, all items are based on total assets. All items are based on total assets. Then when you come to horizontal analysis, horizontal analysis is also called the trend analysis. It is based on a particular base year. So the items are in consideration, and the horizontal, it is based on a particular base year. So for horizontal or the trend analysis, that one is based on a particular base year. But when we talk about the vertical statement, you need to consider two items: the items of the income statement, which is based on the total sales, and the item on the balance sheet, which is based on total total assets. So let us say something when it comes to the common size analysis. So we talk about the vertical analysis, as I said. So vertical analysis is where we account each item. So each item or each account in the financial statement is expressed as a percentage of a particular base account. So every item in the income statement or the balance sheet, we talk about the vertical analysis, is expressed as a percentage of a particular base. Now let's start with the first one, the income statement. So we talk about the income statement. So each item in the income statement is expressed as a percentage of total revenue. It's expressed as a percentage of total revenue or total sales. Total revenue or total sales. This type of analysis is help us to determine uh, the effect of various components on profit. For example, maybe expenses, they were they increased rapidly during the year and therefore the profit reduced, or maybe we had an increment in revenue from one period to another, therefore the profit also increases, and so on. So it is used to compare each to express each component with the effect in uh, each account as effect on total sales. But remember, sales it's always 100%, so sales cannot have effect on sales. But the rest of the item you need to determine. Then you have the statement of the financial position. So every item or every account in the statement of the financial position is expressed as a percentage of total assets or total equity and liabilities. Total assets or the total equities and liabilities. That one is correct. Then for income statement, as I said, every item is expressed as a percentage, of uh, total revenue. So that's all about the vertical statement. Let us see the horizontal analysis. Horizontal analysis. Horizontal analysis. Now, for horizontal analysis, each account value is expressed as a percentage of a designated base year account values. So when we talk about the horizontal, so horizontal is also called the trend analysis. Actually, it's also called the trend analysis. So each item is expressed as a base of a particular year. For example, we can have 2020, 2021, 2022. Now, with this information, we can analyze financial statement using a base year of 2020. So 2020 will be our base year to analyze 2021, 2022, 2023, and so on. So when we talk about the horizontal analysis, this is where we have a base year as a base for analyzing the financial statement. In this case, when we talk about the horizontal analysis, we do not consider vertical or horizontal, but we consider the trend within different period. Within a different period. So let us write down. Now, good. So when we talk about horizontal analysis, as I said, each account value. So each account value, for example, 2021, 2022, is expressed as a percentage of the designated value of a base year. A designated base year account value. So in our case here, the designated base year is 2020, which is used to analyze the year 2021 and 2022. This allow the analyst to see how the item have changed over the given duration. So it allow the person analyzing the statement or the person who is the user of this information to see how the items, or for example sales, how sales have changed from the year 2020 to 2021. Was there an increase in sale or a decrease in sale? What about the expense? So has the expense been increasing from that period, or they have been trying to cut down the expenses through the period from 2020 to 2023 to 2024 to 2025? So that's all about the horizontal analysis. I'm not going to do a question at the moment because I said this theory part will be applicable for both financial accounting students, financial management students, and financial reporting students. So at the moment I'm not going to do any question, but I'm going to explain all those items as I move forward. So the first one was the common size analysis. We can call it number one, common size analysis. We can go to number two for comparative analysis. Comparative analysis. So comparative analysis. Comparative analysis. So the first one we said was, I started with this one, common size analysis. So number two is the comparative analysis. Then we finish with the ratio analysis. So let us go to comparative analysis. and see what are they talking about. Now, comparative statement analysis. Comparative, it's supposed to be comparative statement analysis. Comparative statement comparative statement analysis. Now, the comparative statement analysis deal with the comparison of different items in the profit and loss and the balance sheet of two or more periods. So, number one, we have the comparative income statement. You have the comparative statement of the financial position. Now, for comparative income statement, very important information are obtained from the comparative income statement. Number one is the gross profit. Number two is the operating profit. Number three is the net profit. That one is okay. When it comes to the comparative statement of the financial position, the financial condition of business concern can be found out by preparing the comparative balance sheet. The various items of the balance sheet for the two different periods are used. That one is okay. We don't need to stay there so much. But remember, the change is also given in percentage. So the change is also given in percentage when we talk about the comparative statement. And how do we find those changes? We find it by finding the absolute change. Then after we find the absolute change, which can be a positive figure or a negative figure, we find now the actual change in percentage. So let us say something concerning the comparative statement. Then we shall do a question later. So let us just let us just do a question. No, let us do the theory part. Then later we shall provide. We shall do a question later. So let us write something to do with comparative statement analysis. So when we talk about the comparative statement analysis, as you can see there, it deals with the comparison of two different periods. When it comes to the P&L, that is the profit and loss account, and when it comes to the balance sheet, and that's also just repetition. So comparative statement, it compares the two periods of a given period of time, and we consider gross profit, operating profit, or the net profit as the main. So we can use the others, but when we say gross profit, it means we have considered everything, operating profit and net profit. So we talk about the gross profit, operating profit, and the net profit. Basically, those are the items which makes the income statement. Then for comparative statement analysis, so we use the various items in the balance sheet from the assets, net non-current assets to current assets to equity components up to the liability components. So let's see the disadvantages of the comparative and common size. Let's start with the advantages. Advantages of comparative and common size. Comparative and common size statement. So number one of the advantage is easy to understand. This method are easy to understand. So you can easily formulate the information once you have the financial statements. So you can easily formulate the information. Number two, it is helpful in time series analysis. Number two, helpful in time series analysis. Number three, so they say that it is helpful in time series analysis. It means that the common size statement help the analyst to find out the trend relating to the percentage shares of each asset in the total asset in a given period. In short, it can be able to tell you the trend. And then comparison at a glance. So it's also another one is comparison at glance. Comparison at glance. So an analysis can compare the financial performance at a glance. Since the percentage of increase or decrease in each individual, since there is a percentage increase or decrease in items, either in the income statement or in the balance sheet. So by just looking, you can easily tell the trend, or you can easily do the comparison by just looking at the statement, as long as the percentage are provided for the vertical analysis and the horizontal analysis. It's also helpful in analyzing structural composition. Helpful in analyzing structural composition. It is helpful in analyzing structural composition. That is various components. So it can easily analyze various components from the income statement to the balance sheet. You can analyze the expense, you can analyze the assets, you can analyze the liabilities, you can analyze the gross profit, and so on. So it is helpful in structural composition analysis. Then let us see here disadvantages. Disadvantages of this method. Number one, it lacks standard ratio. So it lacks the standard ratio. So one is it lack standard ratio. Number two, now when you say it lacks standard ratio, now for example, when you are analyzing the when you are doing the comparative analysis, each item is based on itself. So there is no any standard that it can be used to value a particular metric. So each item has its standard. So you find that if every item, for example, I talk about the comparative income statement, every item has its standard. For example, the profit, the standard is the base year for that profit. If you go to the net profit, the standard is the net profit, but we do not have any standard ratio to govern that one. It's also affected the change in price level. Changes in price level. So when price keep changing, this method becomes inappropriate because it will not capture the changes in price level. Following consistency. Now, in the case where the financial statement, there is no consistency in the preparation of the financial statements, then this method becomes not suitable in that case. So this method is only applicable when we have consistency when preparing the financial statement from one period to another. But if the financial statement there is inconsistency when using the methods that the accounting policies, conventions, and so on, when we have those inconsistency, this method becomes a problem to use. It's also affected with seasonal fluctuations. Seasonal fluctuations. So seasonal fluctuation is where like we have a boom season where we have a lot of sales. In another season, we don't have the boom sales. So it is actually affected with that one. Also window dressing. So window dressing is where there is manipulation of the financial statement. Window dressing. So this is where the financial statements are made to look appealing, but in real sense, they are not fair and true. So in that case, when you have window dressing, this method becomes inconsistent, or will become not that good. Not good. It will not fit because it will be deceiving. Then qualitative elements. So it does not capture the qualitative elements. It does not capture the qualitative elements. So the common sense statement fails to recognize the qualitative elements such as the quality of work, the customer relation, environment where the people work. So it does not capture all those kind of item. Now we are done with the second part. So let's go to the first part, that is the ratio analysis. Ratio analysis. Ratio analysis. Ratio analysis. Ratio analysis. That will be our last part so that we finish what we call the analyzing of the financial statement. So ratio analysis. So for ratio analysis, uh, so, ratio analysis is just a mathematical expression that compares two or more related values. So it's a mathematical expression which compares uh, two or more values. But when we talk about the ratio analysis is a quantitative method. When we talk about quantitative method, we're talking about the mathematical method or the statistical method. But let us go with the word mathematics. So refer to the quantitative methods of gaining insights in the company liquidity, that is the liquidity position, operation efficiency, profitability, by analyzing its financial statement, key ratios. By analyzing its financial key ratios. So we have the key ratios that we can have. So we have the liquidity ratio, we have profitability ratio, we have the efficiency ratio or the activity or the turnover or the asset utilization ratio. We have the leverage ratio, which is also called the solvency ratio, or the gearing, that is the use of debt. Then you have the market value ratio or the investor ratio or the valuation ratio. These are the ratios which are used to determine, we're talking about the market value ratio, to determine the value of the company. For example, the earning per share, the market price per share, and so on. So we shall start with the first one. We shall start. I think we shall. It's not necessary we follow the order, but let me write them here so that once we finish, we take. So number one, we have liquidity. Liquidity. Number two, we have profitability. 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 So then we have the efficiency. We have the efficiency, or what we call the activity. Or what we call the activity or the turnover or the asset utilization. Number four, leverage. Leverage, we have solvency. We just call the gearing. Then we have the market ratio, market or the investor, or the valuation ratio. So these are the ratio. So once we are done, I'll be taking. Now we have those are the key ratios. Then let us see the advantages. Number one, the ratio can be used to determine the ability of the company to meet its financial obligation when it matures. You can add when it matures. When it matures. Number two, it can show the extent to which the company it shows the extent to which the company has borrowed fund. That's another advantage. It can show the extent to which the company has borrowed fund. It can be used to compare performance between companies. That's what we call the industry analysis. It can also to compare company with its competitors. That is the cross-sectional analysis. Then it can be used to compare performance of a company over time, so from one period to another. That's what we call the trend analysis. Then it can be used to determine the value of the company. That is what we call the valuation analysis. Then you have the disadvantages. it does not take into account the changes in prices from one period to another. Number two, it is difficult to analyze when the difficult to analyze statement where we have different when company are of different size. So when we have different companies with different size, then ratio analysis could not be a very good metric. Then it's not also applicable to compare performance of the company in the case where different company uses different accounting policies. So it's not applicable when the company uses the same accounting policy, but where the company uses different accounting policies, the model is not applicable. It does not capture the qualitative aspect. For example, qualitative aspect is, for example, i.e., customer satisfaction. So customer satisfaction, employee motivation, blah blah blah. So it does not consider those items. We call them the qualitative. Then, in case of a monopolistic market or monopolistic companies, it is very hard to compare performance. It is very hard to compare performance. Then it's not applicable in the case where there is a lot of window dressing within the company. So remember, window dressing is the aspect of manipulating the financial statement to look appealing in the eyes of the shareholders or the stakeholders. So in that case, window dressing will not be applicable. Window dressing will not be applicable. So in that case of window dressing, this ratio will not be applicable. So in that case, let's start we shall start with number 5. Let us start with valuation ratios. Let us start with the valuation ratios or the investors ratios. So valuation ratios or the investors ratios. So let us start with the first one, the market ratio. So we call it the market ratio or the investor ratio or the valuation ratio. So this ratio is used to determine the value of the company. So when we talk about the valuation ratio, it is used to determine the value of the company. So one of the ratios is the earning per share, EPS. Now for EPS, it indicates the profitability available for each share held by the investor. So it indicates the profitability which is available for each share that is held by an investor. So EPS is equal to profit after tax divided by the number of outstanding shares available or fully issued and paid. Number two, you have the dividend per share, DPS. It indicates the actual cash received by the investor as dividend for each as a share for each as a dividend for each share held. That is correct. So it shows the amount that is attributed to an investor who hold a share in the organization. Now, DPS is equal to dividend paid divided by the total number of shares, or you take the EPS, you multiply with the dividend payout ratio. So whichever available you use. So EPS times dividend payout ratio or total dividend paid divided by the total number of the ordinary shares. Earning yield is our next metric. It indicates the percentage return of every amount invested in the company. So it indicates the percentage return of every amount invested in the company, and that amount is paid in terms of EPS. So that is the percentage return. How do you get it? So you take the EPS itself, divided by the market price, then you multiply by 100 to get the percentage of the earning per share as the percentage of return. That one is correct. Dividend yield, it indicates the percentage return of each dividend for every amount invested in the company shares. So you take DPS over MPS, you multiply by 100. Dividend payout ratio, we have it here. Dividend payout ratio, it is the proportion of the earning which is available to the investor. So the amount that is supposed to be paid to the investor. So dividend payout ratio is equal to DPS over EPS. So it's equal to DPS over EPS, you can see it here. Or you can take 1 minus retention ratio. Now, if the retention ratio is 40%, then dividend payout ratio will be equal to 1 minus 0.4 times 100, which will be equal to 60%. Or you just say 100 minus 40%, which is 60%. So this one is in form of ratio, but in form of percentage, you take. So if you are doing it in form of percentage, then you shall say that dividend payout ratio is equal to 100% minus retention ratio percentage. Anyway, that is correct. Then you have the dividend cover. It indicates the number of times the ordinary dividend is paid out from the earnings. It shows the amount of dividend. How many times can we pay our dividend from the EPS? So that is what we call the dividend cover. So it shows the amount, how many times can we pay dividends from the earning per share. Then you have the price earning ratio. It shows the ratio between market price and EPS. So price earning ratio is equal to MPS over EPS. That is number one. The market, market, or we call the valuation ratio. Number two, let's go to the liquidity ratio. Liquidity ratio. Now for liquidity ratio, this is a ratio which shows the liquidity position of the company, or is the company able to meet the short-term finance, or the, so that is all about this. It's about, when you say the word liquidity, we're talking about obligation. We're talking about obligations. So we are talking about obligations. So let's go to the liquidity ratio. Mostly we have three of them or two of them. So liquidity ratio is a measure. This measures the company profitability to meet the short-term obligation. I think we can write something. We can write something concerning this one. Oh, anyway, so liquidity ratio, shall consider, I think, three of them. We shall consider three of them. So for liquidity ratio, so it measures the ability of the company to convert the short-term obligation to settle the short-term obligation. So it shows how the company can easily pay its debt effectively without problems. So we have three type of liquidity ratio. We have the cash ratio, not cash, sorry, current ratio as the first one. So current ratio is equal to current assets over the current liability. So it shows if the company can be able to repay its debt within a year using all its assets, using all its current assets, using all its current assets. That one is correct. Whether liquid or not liquid, all the assets. So just within a year. So a ratio of 2:1 or a ratio of 2 is most recommended when it comes to current ratio. Then you have the quick ratio, or call it the asset test, is equal to the current assets minus stock. We divide by the current liabilities. So current assets, CA means current assets minus inventory or minus stock over current liabilities. Now this one shows the ability of the company to repay its debt from most of its liquid assets. So remember, inventory is not a liquid. It's not liquid because it's very hard to sell your inventory or to convert the inventory into cash. So we are removing the aspect of inventory because it is not most liquid. So without it, how fast can we repay our debt? Now stock is excluded in quick ratio analysis because of the two reasons. Number one, it is difficult to convert it into cash, and number two, the stock is valued at lower of the cost or the net realizable value. So those two. So the stock is valued at the lower of the cost or the not realizable value. Then you have the cash ratio. Cash ratio now means cash and cash equivalent, or the cash divided by the current liabilities. This one is to show how the company can easily pay its debt using only their liquid assets, assets which are already in cash. So how fast can the company repay its debt? How fast can a company repay its debts? So how fast a company can repay its debts from the liquid asset only? From the liquid asset only. Let's go to the next one, the gearing. The gearing or the leverage or solvency. So the leverage, the solvency or the gearing ratio will be our next part. It will be our next part. Then we shall be remaining with the two. So we need to complete them all together today. So profitability and efficiency will be the one which is remaining. So but let us go to the next one, the gearing ratio. So for gearing or the leverage ratio or solvency, now this ratio indicates the company. These are the ratio which indicates the company's financial risk. So these are the ratio which indicate the company financial risk. So we have the first one, debt to equity ratio is equal to total debt over total equity. So it indicates the amount of loan that is used. It indicates the amount of loan term debt for every amount of equity capital invested in the company. So how much of debt is invested when we compare it with equity, or how much of equity has been invested if we compare it with the debt or vice versa. So how much? So the extent to which debt is used when we compare it with equity. That is correct. Number two, we have the debt ratio or the gearing ratio. That is the total liabilities over total assets. So it shows the extent to which the total assets are being financed from the total liabilities. So how much are we using in terms of debt to finance our total liabilities? So how much are we using to finance our our total assets? So how much are we incurring to finance our total asset? Next, we have the fixed charge ratio, which is the fixed return capital over total capital. So it indicates the proportion of the total capital which has fixed return. So how much of our capital has the aspect of fixed return? Then EBIT, interest coverage ratio, or the times interest earning ratio. It's supposed to be times interest earning ratio. So it shows how much can we pay the fixed interest from our profits, from our operating profits, before we exhaust our normal profits. So how much, or how many times can we pay expenses in terms of interest expense from our operating profit before even we exhaust our profits. Then you have the multiplier. So it shows how much assets are being financed by the shareholders fund. So when we talk about equity multiplier ratio, this is a ratio which shows how much assets are being financed by the shareholders fund, and is equal to total asset over total equity. That is all about the gearing ratio. We can go to the next one. We can proceed to profitability ratio. We can proceed to profitability ratio. Profitability ratio. Then the next one, the activity ratio will be the last one. The activity ratio will be the last one. So let's go to profitability ratios. Profitability ratio will be our next item. So remember, we talk about the gearing or the leverage ratio. These are the ratio which indicates the company's financial risk. So they indicate the company's financial risk, and we have 5 of them. So we have 5 of them. So let us move on to the next ratio, which is profitability ratio. Then once we are done with the profitability ratio, then we shall be remaining with the efficiency ratio. We need to complete all of them today. So let us do profitability ratio. So for profitability ratio, we have several of them. We are going to explain them in one part, as you can see here. So profitability ratio, these are the ratio which indicate the ability of the company to generate return from its sales or investment. So it can either be sales or investment. So we talk about the ability of the company to generate return from its sales or investment is what we call the profitability ratio. So we have 2 of them. So profitability in relation to sales and profitability in relation to investment. So let's start with the first one, profitability in relation to sales. So we start with the gross profit margin, as you can see, gross profit margin. So I've called it GPM. So GPM is equal to gross profit over sales. Gross profit over sales times 100. Now it indicates how well a company has produced its goods when you compare to the cost of production. So if you have managed to utilize or to cut on cost, then the gross profit will be good. So that's how well the company has utilized its cost when it comes to the cost of when you compare to the cost of production. Now operating profit margin also apply the same. It's EBIT over sales. EBIT, earning before tax, supposed to be earning before tax. Earnings before tax over sales. That is correct. It shows the same item. How have we managed to reduce our costs in terms of production and some part admin cost. Then you have the net profit margin. So it indicates how well have we managed to how efficiency have we. We can talk about how efficiency can we generate profit? Can we generate profits from sales? So it indicates how efficiency can we generate profit from sales, or it indicates the percentage of revenue which remains as profit, which is the same thing. So how much can we retain as profits? So you have the operating expense ratio. This it shows the expenses relating to total expenses relating to sales, excluding the interest expense. That one is okay. Then you have the second item, profit in relation to investment. Profits in relation to investment. Now this one, we start with the return on investment. Return on investment, ROE. Return on investment. Some people call them the return on total assets. So you can also call them the return on total assets. So it's equal to the net profit over total assets times 100. So net profit is the same as earning after tax. Once we remove tax from the earning before tax, you get the profit after tax. So the profit after tax is the earning after tax or the net profit. Net means tax has been deducted and other expenses. Now this ratio indicates how well can we generate profits from our total assets. So how well can we generate profits from total assets? Or you can use this one. It indicates the percentage of return from utilizing total assets. So the percentage of return is the profit. So how well or how effective can we generate profits from total assets? Number two, return on investment. Return on RO. So it's supposed to be return on what? Let me return on equity. Sorry, yes, supposed to be return on equity, ROE. Return on equity. Return on equity, or you can call it the return on net worth. You can call it the return on net worth. So it's equals to the net profit over total equity. Now this one shows how effectively can we generate our profit from the total equity. So how well can we generate our profits from total equity? So it indicates the percentage return. It indicates the percentage return from utilizing the total shareholders fund. So how well can we generate our total profit from the shareholders fund? Then you have return on capital employed. ROCE. ROCE is return on capital employed. Return on capital employed or return on net asset. Or you can call it the return on net asset. Is equal to the net profit over net asset. Now it shows how efficiency can we generate our profit from the net assets. So remember how to get the net asset. Net asset which is equals to the same as the capital employed, which is equals to capital employed, which is equals to the total assets minus I think current liabilities. Oh, sorry, total liabilities. Total. So remember, total liabilities excluding the equity capital, excluding the equity capital. Total assets minus total liability. I think that one is okay. So we are done with that one. We can go to the final one, which is the efficiency ratio. Efficiency ratio. Efficiency ratio. So this one indicates the profit from cooperation. It indicates, can just say it indicates profits from co-operations of the company, of companies. Cooperation of the company. Cooperation of the company. Now this one you can also call it the equity capital. You can call it the equity capital. So you can call it equity capital, which is made up of share capital, retained earnings, and other reserve. It's made up of ordinary share capital, share premium, plus other reserves, evaluation reserves or reserves, just call them reserves, plus reserves. So ordinary share capital plus share premium plus retained earnings. You can call it the retained earnings here, plus reserves. So let's go to the last one. The last one will be about the efficiency theory, the efficiency ratios. Efficiency ratios, or the activity ratios. Efficiency ratios or the activity ratios. So let us finish the last one. The last one is the efficiency or the activity ratio. So this is the ratio that indicates how efficiency the company utilizes its resources, that is its assets, to generate revenue. Revenue. So how efficiency does the company utilizes its assets or resources? Let's use the word resources to generate revenue. Number one, we have the stock turnover or the inventory turnover, which is equal to cost of goods over average stock. So it indicates the frequency at which stock is converted into sales. So it shows how frequency does the company convert its stock into sales. Number two, we have the debt turnover ratio. How frequency does the company take to collect its money from the customers or the debtors, from the customers or from the debtors? So how frequent the company takes to collect its money from the customers or the debtors. Then you have the credit payables or turnover, the credit or payable turnover. This is equal to credit sales of average payables. So how quickly can the company pay its suppliers? So how fast can we pay? Now, apart from collecting money from the debtors, now how fast can we pay our creditors, suppliers? So it shows how frequency or how quickly we pay what belongs to others. We have the fixed asset turnover is equal to sales over fixed asset. How fast can we utilize fixed asset to generate sales? So how well or how efficiently can we use our fixed asset to generate sales? Then you have the total asset turnover is equal to the sales over total assets. So it indicates how well or how efficiently or how efficient can we utilize our total assets to generate sales. We have the stock holding period. Stock holding period is equal to the number of days in a year. So remember that number of days in a year can either be 365 or 360, depending with the question. So you check on the question over the stock turnover, over the stock turnover. Stock turnover, we have it here. Stock turnover, we have it there. Or you take 365, you multiply with the average stock over cost of goods sold. Now it indicates the number of days the stock is sold in the store before it is sold. So how long does it take for an inventory to be sold? So how long does it take to long does it take the stock in the store to be sold? So that period when the stock is in the store before it is sold is what we call the stock holding period. Then you have the data collection period. Now it indicates the number of days a customer takes to settle his account. So is equal to number of days in a year over the turnover, or 360 or 365. You multiply with the average data, divide with the credit sales. So number of days a customer take to settle its account. Then you have the credit collection period. This one is the number of days taken to repay. Number of days taken by the company. Number of days taken by the company now, so to repay its suppliers. So it's equal to number of days in a year over payable turnover. Payable turnover, we have it there. Or 365 or 360, depending on the question, it can be 365 or 360, and the average payables, then you divide it with the credit payables. That one marks the end of financial statement analysis. Now, what is remaining now is to do some questions. So when we meet in our next class, we shall do a question for FRA, financial statement analysis for ratio. Now, up to now, I hope you are conversant with the financial statement analysis as a topic in financial reporting. So as a topic in financial reporting. So when we meet in our class, in our next class, that is lesson 2. Lesson 2 of the financial statement analysis. We'll be handling past paper question. Past paper question. Questions from CASNEB past papers. From CASNEB past paper. And lesson 2, maybe we shall have another lesson 2 and lesson 3, and that will mark the end of the financial statement analysis. That will mark the end of the financial statement analysis. So that when we finish that one, we shall go directly to IIS, International Accounting Standards, and International Financial Reporting Standards. So this one will be our focus once we finish this topic. So we have done group account and cash flow, so that's good. So group account must be there in your exam. Cash flow, we have done cash flows. So I'm supposed to do published, but before I do published statement, this one I won't be able to do if I haven't covered this item, the International Accounting Standards and IFRS. So once I'm finished with this one, then I will come to publish, then partnership. So once I'm done with this item, 1, 2, 3, 4, and this IFRS, then financial reporting will be over, because all the IFRS that we shall cover in IAS, it is there in your past paper, and for both theory and computation. So this one we shall focus where we have theories and computations but the rest. So if we find something else that already covered in group account, we shall ignore in the cash flow. So, but this one we need to do this one IFRS. It's a must before we do the published statement. then partnership will be our end. So once we manage to finish all this IFRS, then the only topic that shall be remaining is the partnership and what else? And the accounting for cooperative and professional firm. Cooperatives and professional firms, professional firms. So our focus now, after this lesson, it will be IS and FRS specifically. So that will be our focus. So let us meet in our lesson 2 of the financial statement analysis soon.